Good morning. Lease versus buy, the true cost breakdown. And when business owners evaluate their space needs, the first question is often simple: should I lease or should I buy? And the better question is: what does each option actually cost me over time? And in commercial real estate, the lease versus buy decision directly impacts cash flow, tax strategy, balance sheets, long term equity, and exit options. And below is a practical, numbers driven breakdown to help investors and owner users make informed decisions. The true cost of leasing commercial space. And leasing offers great flexibility and lower upfront capital requirements, but it comes with long term financial trade offs. And some common lease costs are going to include some of the following. So you'll have a base rent, which often escalates annually. And then you have your triple net or NNN expenses. So think taxes, insurance, and CAM. And as well, you have to worry about tenant improvement or TI, whether it's contributed out of your own pocket or paid by the landlord. And rent escalations, expect 2 to 4% annually. That's pretty common. You have renewal risk and re-tenanting disruption. And here's the hidden cost reality. Rent is a 100% expense with no equity creation. And over a 10 to 15-year period, tenants often pay more in rent than the purchase price of the building itself without owning anything at the end. So let's look at the true cost of buying commercial property. Ownership requires more planning but creates long term financial leverage. And some ownership costs include the following: you're going to have your down payment, often 10 to 20% with SBA or bank owner user financing. So you have your debt service, your loan, your principal and interest payments. And then you also have your property taxes, your insurance, and your maintenance costs, and any capital expenditures. So if you need a new roof, an HVAC, or parking lot upgrades. Let's take a look at some of the advantages of ownership. So you have equity buildup with each payment, and you have tax benefits through depreciation and interest deductions, and you have rent replacement with fixed debt. So basically, it acts as a hedge against inflation. And you have appreciation in the building and exit flexibility. And if you have excess space, you can lease some of that for income. So here's the key insight. Many owner users discover their monthly ownership cost is comparable or even lower than leasing, especially when combined with SBA 504 or 7A financing. When does leasing make sense? So, short term occupancy, think under 5 years. If you're experiencing rapid growth or contraction is expected. If capital preservation is critical for you, that's another reason. Or if you're uncertain about your location strategy. Now, let's look at when buying makes sense. So, when you have a stable or growing business and you're planning for long term occupancy, so 7 to 10 years or longer, but you have a desire to control your costs and you have a strategic wealth building mindset. So here's the bottom line: leasing may feel easier today, but ownership often wins financially over time. And the right decision depends on your time horizon, your capital structure, your tax structure strategy, as well as your business stability. And if you're paying rent right now, you are already servicing someone else's mortgage. The question is whether it makes sense to start servicing your own. That, my friends, is it for the day. Please visit my website, Houston Real Estate Brokerage, to get a hold of me, and love to talk soon.